Hello, everybody. I'm Michael Smith. Welcome to the big, beautiful Lowdown. Joining me today, Kevin Lennox. Kevin, welcome back. It's been a little bit about a month since we did the last show, and we're rolling up our sleeves. Obviously, there's a lot that's happened. I mean, I don't even know where to start. But
to the upside, though, we had the best May
Very
in
true.
30 years. The NASDAQ was up 9%.
yes, it was.
S&P up 6%. So we were talking recession odds last time, and
Yeah, it was.
now
it was
not so much.
It was looking quite gloomy, and then since the last time you were on, it kind of hit a trough. We had some battles in Washington. I think we all know who that was. That seems to be simmering down for now. I'll spare everybody. I'm sure everybody's got their details on that, but quite embarrassing, by the way. But I think right now probably the big thing is, and I'll let you kind of give the results here, but Consumer Price Index (CPI) that came out. What did that tell us?
Across the board, cooler than expected.
Okay.
Everybody's been waiting for, when are the tariffs going to leak into the CPI data? Well, not yet.
Yeah, it's too soon.
Actually, it's only 10 to 20% of the goods connected to the tariff that are in the CPI basket.
Yeah.
So that's really not where we're going to see it.
Okay.
So CPI.
That's a good point, by the way.
Core, I think it's 2.7 now on a year-over-year basis. So not where the Fed wants it. Wage growth is still at 3.5% annualized. So the Fed's really not in a position to cut here. I think that was all pretty premature. But when you look at a broader measure of inflation, and I would argue perhaps more accurate than CPI, which is always manipulated.
Yeah.
But the ISM, both manufacturing and services, were very elevated and have been over the last couple of months, which tells you then that prices are still rising. Now,
Okay.
We're not calling for any kind of a hyperinflationary type of period at all, but also not just a one-time jump and then forget about it.
Exactly. Well, I think to your point, you talk about sticky inflation a lot. The services and what you're seeing. While it might not go up, exponential from here, it's also not going to retreat. That's the one thing I think people don't realize. And so, for instance, for lower income, it's probably going to be on a percentage basis, it's going to hit them the hardest. And over the next 5 years, it'll average out, but it hits you very hard now. And that's the thing. That's where you see the big impact, is it hits people very hard in the first couple of years of it, and then it'll settle out. Well, that's great, but this first couple of years are not fun.
Yeah, kind of interesting on a side note, there was a study that the top 10% of the country in income accounts for 50% of total consumer spending.
Wow.
And the bottom 20% account for about 10%.
Yeah.
So, we talk about the two mandates of the Fed as far as watching the economy: full employment, 1; stable prices, 2. Well, and the Fed would really watch the labor market.
Okay.
And that used to be the big swing indicator in the economy. And now with stocks and other risk assets in real estate owned primarily by the top 10%, 1%, now it seems like, and I made this observation for a while, that risk asset prices tend to be kind of skewing some of the economic data.
Sure.
More so than just changes in the labor market, which have been fine. Unemployment has been steady at 4.2%. But the unemployment rate for 22 to 27-year-olds with a college degree is 5.8%.
Okay.
So maybe AI is starting to replace some of the entry-level type positions.
Absolutely. We see it here. I could tell you this right now, where I'll just pick the accounting department. We're typically, before AI, you'd probably need 4 or 5 people. We got 2 people, 3 people in there with all the programs and all the efficiencies there is that we need. So yeah, I think that's going to be, and especially AI is now getting heavily integrated amongst all departments everywhere now. And at some point that'll smooth out, and then don't even get me started when quantum jumps in. That's going to be a whole different level. We'll talk about that at maybe another time. But I'm going to get back to something, because you mentioned, the Federal Reserve has been, and you've been hearing it publicly by the president. He's been urging them to basically cut rates, right? So that's what he wants to do. Now, the data that came out doesn't look very compelling. If I'm the Fed chairman sitting there looking at the data going, well, why would I want to cut right now? I'd probably want to reserve any future cuts for, maybe something goes wrong, right? But I was going to get your opinion on what the Fed should be doing here? Or do you agree with what they're doing, or do you think they should cut? Where are you on that?
I think they're good on hold for now.
I do too.
And,
Okay.
and again,
Okay.
going back to the mandate. So full employment, unemployment rate's 4.2%. We're not seeing a jump in initial claims. We're not seeing a jump in the WARN notices, which typically precedes a jump in initial claims. So the labor market, I think, is still just balancing. It does not look like it's weakening.
Yeah.
At least at this point. And then when you look at stable prices, as I've been saying for a long time, I think inflation is going to be more sticky. If you look at the ISM reports, you can't have price paid components in the mid upper 60s and make a case for cutting rates. So
Exactly.
and we don't know the read through yet. It's still too early on the tariffs. Hell, we don't even know what the tariffs are going to be still.
I mean, a rate cut or a rate hike takes about 6 to 9 months to work through the economy. I would say probably the same thing of a tariff. It's going to take somewhere in that to really see the full effect. So I think it's smart. The Fed needs to use its bullets, which I believe they're very limited. They need to use their bullets at the right time. And so I agree with your point on basically kind of holding off, waiting and see, before you go in there and just start cutting rates for
every president wants lower rates.
Well, of course,
to juice the economy.
Yes, exactly. We know how that game
One's
works
just
out.
more vocal about it than others have been.
Well, let's get back to let's move on to this the triple B bill, or the big beautiful bill. We're obviously seeing a lot of different commentary on that, and some people agree and all that. But I think it adds $2.5 trillion in spending, right, over the next, or to the deficit over the next 10 years. And, this just brings me back, and this is a question I want to ask you. There's different types of debt, right? There's a non-productive debt. So that'd be like you and I going to Vegas for the weekend. We go charge it on our credit card. That's non-productive debt. Versus we go to a conference where we learn something and we put that back into our trade. That's productive debt. So the government has spending that could be productive later on, and then of course we have non-productive spending, and it's probably too early to really know how much of that is actually productive debt that we're going to see, or productive spending versus non-productive. But anyways, what's your take on the bill? I know you probably haven't read all 1,500 pages. Neither has anyone else.
I'm on 1,497.
Yeah, 1,497.
So
yeah.
almost there.
No. Yeah.
Not close.
But what are your thoughts on it so far? And then, all the rhetoric that's happening. What's your take?
I think, as expected, and I'll call it fiscal stimulus, is front end loaded.
Yeah.
The savings, the reduction in spending is back end weighted. So I think it's fair to expect a boost to nominal GDP from this.
Yeah.
Hence the sticky inflation.
It keeps us out of a recession if that's the case.
And why I've been saying for a while now, cyclicals versus defensive stocks. When you have fiscal stimulus, a Fed on hold, corporate earnings still going up. We're expecting 9.1% now in S&P 500 earnings growth, led by the large companies. Then that's all skewed to growth.
Yeah.
Less regulation, bring more manufacturing home, some of the tariff income. The goal is GDP growth that exceeds the growth rate of the debt.
Yes.
That's the goal.
The goal.
Hopefully it's productive.
Hopefully so. Well, and it's going to take a long time for me to really figure that out. But I mean, again, you hope that they were pretty good at forward thinking on this, and we'll see over time. But I agree with you. It's got to boost GDP, because we're not seeing cuts in spending, right? I mean, Doge I think it was exciting. I think the spirit of it was great, but we've seen a lot of waste. I can only imagine how much more if they're given the time to really dig through there and actually do something. I think they could find a lot more, but that kind of faded away here recently, as we know.
That to me is most disappointing.
Yes.
This was the first real attempt to make meaningful cuts in spending, and they just let it.
And if this dream team, at least at the beginning, I was thinking, okay, if anyone can do it, the biggest disruptor in the universe, being Elon, and of course, the no nonsense, I don't take any, from anybody, Donald Trump. If those two can't do it, that tells you just how bad Washington is. It's pretty sad.
I think Musk was willing to do
I do too.
his part.
Yeah.
maybe a bit too heavy-handed.
But it didn't go politically favorable.
Yeah, showing up in all black. And,
Yeah.
and dark sunglasses, a black hat, and a shiny chainsaw. With the implication, you're cutting a lot of jobs. Is not.
I mean,
maybe the best.
This isn't the Jersey Shore TV show, right? I mean, come on. We got a little carried away with that, but yeah, I agree with you. We just got to keep it professional. Well, so on the bill, I agree with you. It's again, not as favorable, disappointing a lot. I think the expectations and the excitement was there, the momentum was there, Absolutely. And it just it's like the balloon the helium didn't just disappear, it got popped. Yeah. It got popped. So
now you wind up with more of a fiscal stimulus bill.
Yes.
To juice the economy versus more balanced.
Mm-hmm. Well, let's kind of wrap it up here. As we know, we've had the negotiations with China, right? That's been really, when you boil it all down to it, take all the other countries out of it, it's really China and the U.S. I mean, I think for the rest of our lives, Kevin, and probably for our kids, we're going to be in this duopoly of, this world power, fight for world power. It's not just the United States, but it's going to be U.S. and China. And I think we're going to see the world kind of divided, friends of China, friends of the U.S. I think that's likely what we're going to see. I'm hoping that we don't slowly fade our lead to China over time. I think there's places that we can continue to advance, space, defense, those areas, and hopefully we continue with that. But the rare earths was the really big issue, and I think people don't realize the impact of how much hamstrung we were with China when 60% of all rare earths come from China, 90% of all finished rare earths had to get sent back and come from China. So that puts think about everything we're doing from space, defense, from nuclear, all these innovative products, electrical cars, everything that we're moving toward all relies on that. And yet I've been told by people, this has been known for 15 years, if not 10 years. And that's great that we came up with some solution. They're going to give us what we need at the beginning, but it doesn't solve the problem long-term, which is we need to figure out our own solution to this. We need to be mining for that and figuring out, because it's going to take a long time to do that. But I think that's kind of the gist of this whole negotiations. And I think if anything, we found at least a short-term solution, but will China do what they say? Will we actually do what we say?
Yeah. We need to, manufacture and build out those critically essential materials
Yes.
and products that we need for national security.
Yep.
That's something I think really is non-negotiable, is overdue. But for example, the tariffs on Vietnam, I thought reached too far.
Yeah.
Lululemon and Nike make a lot of clothing.
Yeah.
Do we really need to be making clothing here?
No,
not so much.
And I don't want my clothing going up that much. It's already expensive. If you've been to Lululemon, trust me, I don't need it to go up anymore.
And that's why there's so much consternation over Liberation Day.
Yeah.
It was just across the board and massive, not strategic or tactical. So I think they're getting to that place now, which is great. Which industries, which materials do we really need to source at home?
Well, it was a speak first, think later. But we know, if you've read Art of the Deal, Trump, that's the way he is. He goes in with the big shock and then the awe, and then, of course, okay, well, let's think through this. And
I think he got some bad advice early on how to handle the trade.
Oh, no doubt.
And then, fortunately, in my view, he brought in Scott Bessent.
Who smoothed it out.
Yes.
Thankfully. It took, a month for Scott Bessent to come out and say, we're not manufacturing toothpicks. We're not planning to bring all that back. Thankfully, he did that, but that was not the message that came across a month earlier, which it would have been nice to have that clarity beforehand, right?
Yeah.
Because I think we were all like scratching our heads like, wait, we're doing what? We don't want to manufacture. Yeah.
That's why we had a bear market.
That's exactly right.
So quickly. And
yes.
then why we had the V shape afterwards. Like, wait.
Yeah, the uncertainty created by that comment was pretty crazy. Well, I'll tell you what, we got a lot to get through. I'm not sure if this is going to be a quiet summer or not. I think we're kind of in a range bound right now at the markets. It seems like we smoothed over with China. CPI came in pretty minimal. So I think for anything, it sets the pace slow. But you know what? That's the scary part. You never know what's coming next, and especially with this administration and what's happening now. Every day something's new.
I will throw out one last thing. So
okay.
a lot of talk about the U.S. dollar.
Yes.
And it's and really what it's done is retraced the gain that it had since the election.
Okay.
But nonetheless, it's been a sharp depreciation in the dollar.
How much down in the dollar are we now?
I think 7%
Okay.
on the year, but it's still roughly 15% overvalued relative to other currencies,
Yeah.
and that's mostly tied to foreign ownership of U.S. stocks,
Okay.
which has gone from about 4 trillion 10 years ago to about 14, 15 trillion
Mm-hmm.
now. And the other talk is this weakness in the dollar, is it cyclical or is it structural?
Yeah.
Following the tariff, and I'm strongly in the camp of cyclical.
Okay. I agree.
What other currency are you going to use? We are.
That's always my saying when people keep talking about, because you've been hearing the articles, the gold bugs are out there talking about the decline in dollar to zero. But then again, it's like, well, where do you go? And I know people are going to say Bitcoin. I like Bitcoin, but that is not, in my opinion, a next candidate at this point.
And as I call the U.S. dollar the cleanest dirty shirt.
It is. It's still the cleanest dirty shirt.
Do we really want the euro as the reserve currency?
No.
The Chinese yuan?
No one's going to go there.
Probably not.
Yeah.
So it's the dollar, a little
Yeah.
bit tainted, but still the best one there. Where I would get concerned is, and we'll see how this big beautiful bill works out, and the confidence in the debt structure going forward, but a decline in the U.S. dollar accompanied by a notable rise in the 10-year yield.
Yes.
Would be concerning.
That would be concerning for sure. Well, you know what? That's a great point to end, and definitely something we want to look at next time and kind of always watch that and see where that's going.
Yeah, some of these 10-year, 30-year auctions have been an adventure.
Yeah.
I think I just saw on the tape before we came in here that there was a 10-year today and it went very well.
Okay.
But like, it's been an adventure. Some do well, some don't.
Yeah. Yeah. Well, that's stuff. I mean, we got to watch the liquidity in the credit markets. Those are the places to watch. The canary in the coal mine.
Absolutely.
Well, Kevin, thanks for coming on. Great stuff, and we'll catch you here soon. And always an adventure. So thanks for coming on. All right.